Okay, so you're thinking, accounting, how hard is it? Every business, no matter how small, requires an accountant to do the magical activity called accounting, to enable transaction recording and give some meaning to the business. What we're going to do here is take the mystery out of this activity and lay open for you the full knowledge of how accounting takes place in a language you can understand. In this video, we're going to set a very strong foundation for your accounting education to be built upon. We're going to cover one of the three pillars that form the core foundation, accounting principles. If you have any accountant friends, they will be shocked at how much you know next time you speak to them. But before we start, to understand things better, take note that when we refer to a company's accounts, we're really referring to the summarized reports showing the company performance over a certain period of time. Okay, let's start. The summarized reports are made up of every single transaction that has taken place in the company for that specific period. Hence, some of the below principles are addressing how these reports should be prepared and how other principles are giving guidance on how the transactions should be recorded. The first one is the accrual principle, and it simply means that when you're accounting for a particular period, say for example January 1st to December 31st, only applicable expenses or costs for this particular period should be recorded. You will immediately understand that this seems to be common sense, and you're right. The best part is that all the principles that you're going to learn are really common sense. That's why learning accounting is quite easy, provided you have the right teacher. And next is the revenue recognition principle. This is the same as the accrual principle, except that it relates to revenue. So this principle means that when you're accounting for a particular period, only applicable revenues for this period should be recorded. The third to consider is the matching principle. This combines the first two principles and states that when revenue is recorded in a particular period, all associated costs relating to that revenue must also be recorded in the same period. In case you're wondering how come there are three principles in place to essentially repeat the same message, this is because time and time again companies keep circumventing these common sense principles to inflate their revenues or to decrease their costs and in turn show higher profits. The fourth accounting principle is called the time period principle, and it states that whenever a business prepares external financial statements, it should prepare them over a standard period of time every time. This is important because any person reviewing the performance of a company by analyzing its financial statements would also want to compare how the company has done in the past. To be able to do this comparison successfully, you need to compare an apple with an apple. In other words, both sets of data should compare a similar time period. The monetary unit principle is the fifth accounting principle, which states that only items with a definite monetary value should be recorded in financial statements. So documenting the worth of your employee abilities, this principle says squash that. The sixth principle is the cost principle, which again expands onto the fifth principle to ensure common sense is documented, so as little room is left for misunderstandings. Following this principle means that any item a business purchases must always be recorded at the exact cost it was purchased, regardless of any increase or decrease in value over time. The next one is the conservative principle. Talk about preparing for a rainy day. This principle in essence states that while preparing the current financial reports, if there's any awareness of any bad news which would affect the company in the future damage it could cause should be investigated, assigned a monetary value, and disclosed in the current financial statements. For example, if a company is preparing its financial reports for a certain period, and the company is aware of a lawsuit that has been brought against it, and the outcome of the lawsuit seems to be against the company, then the amount of damages expected to be paid should be disclosed in the current financial report. If this is the case, then we have in essence broken some of the principles mentioned above, like the accrual principle, right? Yes, you're right to think this. However, what the accounting concepts are trying to do is reveal any bad information as soon as possible, which is usually hidden from external and public users. It is best to do this as soon as possible so that people who deal with the company are fully aware of all events and make any decisions relating to the company in a fully informed manner. The eighth principle is the full disclosure principle. This principle supports disclosing any significant news that may have a negative impact on the company in the future via notes when preparing the company's external financial statements. It's a further expansion on the conservative principle, but in this case, if there are negative events which might be difficult to quantify and assign a monetary value, they still need to be disclosed as notes. The materiality principle is the ninth principle, and this indeed is a strange one. This principle is really only applicable in relation to the preparation of financial reports and not to the recording of any financial transactions. What this principle says is that if an amount or balance has been missed out or omitted in the financial statements or reports, and that if that amount is not significant, then these financial reports need not be corrected, but can be presented with this error or omission. Let's put this in a practical example. If Apple Incorporated prepared its financial statements and forgot to include a telecommunication expense of $40,000, this can really be considered immaterial, as the amount is extremely small with the size of other balances which are in the billions. However, if a small company with an annual revenue of $2 million had made the same mistake, but let's say the telephone expense they forgot to include is only $10,000, then it would still be a material amount, and hence the financial reports would need to be redone. The 10th principle is the reliability principle, which states that any transaction that is recorded should have objective evidence, such as supplier invoices, bank statements, or appraisal reports, to support the transaction. The going concern principle is the 11th principle, and this one concerns only auditors or preparers of external financial statements. It states that when financial statements are prepared, and in particular the balance sheet, that it should assume that the business will continue to operate for the immediate future and meet all of its obligations. If the company is planning to declare bankruptcy or close down in the near future, any prepayments that the company might have made or any deferrals of expenses such as depreciation need to be recorded immediately as an expense. The financial statements should also clearly carry a note stating that the statements are not prepared on a going concern basis. In other words, we are back to worst case scenario planning and recording the worst possible outcome. Finally, the 12th important accounting principle is the economic entity principle. This principle simply states that the transactions of a business should be kept separate from that of its owners. Follow these principles strictly, and you can be sure that your accounting can never go wrong.